The Reserve Bank of India today did cut rates by 25 basis points, which disappointed some who expected a 50 basis points cut. But the central bank made up with its own version of quantitative easing. The governor has promised to reduce the liquidity deficit in the interbank market to near zero from the current 90,000 crore rupees. Bond dealers and economists call it a landmark policy. Ritu, Singh and Latha Venkatesh get to that story.
The efficacy of today will be much more potentially on money market rates and down the road on lending and deposit rates, I think, than even a 50 basis point cut without the change in the liquidity framework may have generated.
This year around, I think the sequencing and the importance of the three pillars of monetary policy is going to be reversed. The first is going to be liquidity measures, as we saw today.
One has to look not just at the 25 basis point rate cut, but I think the way the liquidity stance has been defined.
As the liquidity improves in the market, so I guess the banks will be able to cut their deposit rates.
The central contribution of this policy is less the 25 basis point repo rate cut and more the promise of ample liquidity. Indeed, the master of Mint Street has opened the floodgates of liquidity. He has promised the liquidity deficit will eventually be reduced to zero from the current 1% of net deposits, which is 90,000 crore rupees. The RBI has also reduced the policy rate corridor from 100 basis points to 50 basis points. So while the repo rate stands cut to 6.5%, the reverse repo rate has been up to 6%, while the marginal standing facility rate has been cut to 7% from 7.75 earlier. How does this help?
Because of the MCLR, we actually already have a rate cut of 25 basis points to 50 basis points before the policy. And as this winds its way through the MCLR over the next few months, you'll have more of a rate cut. So don't look at it as 25 basis points. Look at the composite of measures. They all add up. And borrowing rates are coming down significantly in this economy. The effects of the liquidity measures will also help. Will also help transmission, because banks have continuously been saying it's because of liquidity tightness that we can't transmit. Now we've given them enough liquidity. They have the ability to transmit even more.
Bankers complained until now that they were not sure of meeting their CRR commitments due to tight liquidity, and so they were wary of cutting deposit rates. Now, with the promise of surplus liquidity and with the marginal cost-based lending rate and a further 0.25% repo rate cut, deposit and then lending rates should come down in the system.
Rather than, I think impose significant costs on the banking system as they find they have excess liquidity, got to deposit at 100 basis points less, or they need liquidity desperately, they got to borrow at 100 basis points more. This, in fact, makes it cheaper to make mistakes. We don't want them to make mistakes. We would like them to improve their liquidity management, which is why we haven't brought down the CRR daily rate to what they wanted, but more to what we think is appropriate. But at the same time, we want them to see the system as friendlier and pass on the rate cuts that have happened. So this is part of that process.
Bond yields, however, rose after the policy, in part because of profit-taking, but also because the RBI said it may take up to a year to bridge the liquidity gap.
The governor may have disappointed in terms of the amount of rate cut, but he has made up for it by provision of abundant liquidity. Now the Reserve Bank will have to walk the talk. That liquidity will actually have to come into the banking system. If that happens, one can expect a faster and a larger transmission of rate cuts than was seen hitherto. Looks like finally we are going to see interest rates climb down in the economy. In Mumbai with Ritu Singh, Latha Venkatesh.